Get your hands on the brand new Foremost social media suitcase, featuring tips and content for your own social media page, now with LinkedIn, Manta, and more. Foremost, for you. ForemostAgent.com.
It's a time of transition for the commercial property market. While 2011 experienced numerous global catastrophes that had begun to push rates up slightly, by the third quarter of 2012, some of the increases in rates had started to dissipate, according to Mark Bernacki, head of global property for Beazley Group. Bernacki spoke with MyNewMarkets.com associate editor Amy O'Connor at the NAPSLO Annual Convention in October about causes of past and future rate increases in the property segment and why an economic recovery is crucial to demand for this class.
One of the features that I observe in the current market is there definitely is an overabundance of capacity. Now, typically when that happens, you start seeing a soft market emerge and softening of pricing. We're not seeing that yet. In fact, for the past 18 plus months, we've seen positive rate change on all of our lines of business across all three of our geographic platforms in the US, the UK, and Southeast Asia. What's odd about that is with that oversaturation of capacity, I think that underwriters are continuing to practice underwriting discipline, both in terms of risk selection and perhaps even more importantly on pricing. And some of that initiated with the new version of RMS that came out circa 18 months ago. Property tends to be more event specific, or now in the new world kind of driven by changes to the model itself. When the model did change, that's I think what fostered the initial upward pressure on pricing. And then that was just continued with what we saw in 2011 with the degree of international catastrophe losses that we saw, be it the quakes in New Zealand, the flooding the year before in Australia, the flooding in Thailand, obviously the Japanese earthquake as well. I think depending upon whose view you take or which statistics you view, 2011 was either the worst or the second worst year ever from an international catastrophe perspective. So that definitely has kept some upward pressure on pricing as well. While we're continuing to see strong positive rate change, it has started to dissipate as we moved into Q3 of this year. We're still seeing positive rate change, but the degree of that movement now is less, whereas earlier in the year it could have been 10 or 15% increase. Now I'd say the average is probably circa 5, and sometimes for high quality renewals even flat. I would say it's almost entirely driven just by catastrophic perils. The vast majority of our business tends to be surplus lines. We do write some admitted cover in our builder's risk platform, but it's CAT that is driving the strongest rate increases. In non-CAT lines, rate increases may be flat to 1 or 2 points. Again, I referenced our Jeweller's Block book in the UK. That's just only a couple of points up. It's really driven by CAT-exposed areas, CAT cover. And where we feel the pressure to move rates on that is really through some of the reinsurance charges that we have on the back end. In fact, if you look at the largest really outflow of kind of dollars or expense for a property underwriter, it's some of their catastrophic reinsurance protection that's in place. And that reinsurance market has been firming for quite some time, which has led to the rate increases for the insureds. In terms of trends in property, the first thing that I think I'd have to reference is just the overall state of the economy. With economic conditions being challenged, a lot of insureds simply don't have the same amount of cash to spend on insurance as they previously did. From a property perspective as well, because their businesses are moving a bit slower, means their business interruption values are also decreasing. So the actual demand for property insurance to a certain extent, even in a mature segment like the U.S. market, isn't there to that same degree. So that's a very notable trend. I think an uptick in the economy is not only going to help just that fixed property market, but it also will substantially help the builder's risk market, or the market of building buildings, if you will, and other structures. And from a positive perspective on that, we have seen some up movements in that market in terms of more lending, both public and private, coming out that some projects that were previously stalled have been started back up. And I think that that's not only a good sign for the insurance industry as a whole, but also a strong sign that the economy is maybe starting to take a turn for the better.